Hello and welcome to our end of October update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in my book are easy to calculate and adjust each month, for those who are new to the concepts in this book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. This month, there seems to be a common question which I'll answer. Then we'll review what's going on with the 20-month moving average system, and then we'll review the MRI update. So the question of the month. So many stocks got stopped out last month, myself included. When do we go back in? Well, it all depends on your original plan. Why did you get in the first place? Someone, some rumor, some analyst, some TV talking head said that this was a good stock. Why? It sure seemed like a good idea to buy stock in the beginning. How do you know when you're wrong? When I talk about original plans with people, it seems like everyone talks about their plans if the stock goes up. Keep holding. Great, that's half a plan. What happens if the stock goes down? Usually, if they have a plan at all, it somewhere along the lines of, well, if I feel like the stock isn't a good deal after all, I'll sell. Most just hold. Some of you have even held when the stock has lost 90% or more. You know who you are. I won't call you out. But believe me, I feel your pain. Think about it though. If stocks have dropped so much, something is developing, something is happening, either to the stock itself, the whole sector where stock lives, or to the whole economy. Sure, it might be crowd psychology overreacting to some news or string of news, or not. One thing is sure, there is danger when stocks drop below your uncle point, and the lower your uncle point, the more dangerous. The lower your uncle point, the harder it is to recover. So here's a quick review of the 1% risk trailing stop system. The basic premise of the system is limit risk to any one stock or fund to only 1% of your portfolio. If you're using a 25% trailing stop loss, you can buy up to 4% of your portfolio's worth of the stock. If the stock goes up 33%, you can buy more stock. So here's an example. Let's say you had a $100,000 account and you wanted to buy the XYZ stock currently going for $10 a share. At 4% of your $100,000 portfolio, that's $4,000 worth of stock XYZ. At $10 per share, that's 400 shares. If XYZ falls to $7.50 a share, in other words falls down 25%, you sell all 400 shares for a total of $3,000, or a total loss of $1,000, which is again 1% of your account. So, how do you get back in? Do you really love the stock so much you want to get back in even if it's fallen? Remember, stocks don't love you back. I wouldn't recommend buying the stock again. But if you must, remember first how you got into a stock in the first place. It's probably something called random entry. You didn't just read tea leaves or track indicators on a chart to calculate the perfect time to get in, did you? No, you probably heard of some kind of good news somewhere, and somehow someone convinced yourself it was a good idea to get in, and well, you got in. So, if the original reason you got in still holds, and you still love this stock, you can go ahead and get in again. One aside, here in the US, in a non-retirement account, be careful of the wash sale rule. It's just a rule that says if you sell at a loss, if you were to buy back again within 30 days, you can't deduct the loss for tax reasons, but instead you have to add the loss to your new cost basis. This is another can of worms I won't go into here in this month's video. Instead, let's concentrate on just how a few scenarios on getting in again will play out. So, here's our example. $100,000 portfolio, 4% is 4,000. That's how much you can buy XYZ stock. So at $10 a share, you buy 400 shares. Here's XYZ at $10 a share. Now let's say we were unlucky and it just went straight down and dropped 25%. Now the stock is at 750. Well, now it reached your stop loss. Sell the 400 shares at 750 each, or 3,000. You lost 1,000 or 1% of your portfolio. Now your portfolio is only worth 99,000. Now, if you really, really want to get back in, your new portfolio is 99,000. 4% of 99,000 is 3,960. It's close enough to 4,000. If you want to round up that last $40 to 4,000, you can. But for this demonstration, I want to be just very strict so you know how the mechanics work. So at $3,960, $7.50 per share of stock, you can buy 528 shares. Now let's say we're unlucky and the stock keeps dropping 25%. Now, $5.63. You notice how dropping 25%, the stock has already dropped 43%. And you still want to buy, even though it's stopped out. We lost $987 in addition to the $1,000 we lost before. Now our portfolio is only $98,012.64. Well, you can keep doing this. I mean, if you want to get back in, 4%, blah, 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 3920, divide by, there's a typo here, 563, at 696 shares, etc. But let's say we happen to reach the bottom, and this stock at 563 a share starts to go up. It goes up 33% to 750. Well, now, stop is now 563, which is break even. We are essentially without risk now. Our stock is now 696 shares times 750 per share. That's $5,220 that we have in this stock. We made $1,300 so far. So go ahead and buy 528 more shares. Keep that trailing stop loss on. When the stock goes up another 33%, the stop loss is now at 750. So we're again at a relatively riskless stage. We have 696 we bought here, plus a 525 we bought here. At $10 a share, we have $12,000. We only put in almost $8,000, so we've made $4,359 so far. And we've never risked much more than 1% of our portfolio at any one step of the game. So here we can go ahead and buy 400 more shares. So you see the pattern again. When we buy the stock, if it goes up 33%, we buy more. When it goes up 33%, we buy more. Meanwhile, keep that 25% stop loss, trailing stop loss, in force. So let's take a look at another scenario. Yes, we bought the stock, it went down 25%. And we keep buying more as it keeps going down. Now, someone smart can say, well, instead of stopping out at 400 and then buying 528 shares, can't we just buy 120 more shares when it drops 25%? And this way we don't have to worry about the wash rule and things like that if we're going to buy anyway. And the short answer is yes, you can do that. I don't recommend that, and here's why. It keeps dropping 25%, keeps dropping 25%. I mean, sometimes we can get lucky and it could be going up again. Most times it'll just stay down for months or years, and occasionally it can go bankrupt, such as with Enron or WorldCom. So this isn't exactly the best way to keep throwing good money after bad, But if you must do it, at least you're doing it in a controlled fashion where you're not losing more than 1% at any one step of the game. You can still lose everything if you're using stocks. That's why I tend not to use stocks. I tend to gravitate more towards funds and ETFs. But this is how you can handle being stopped out. So that's the 25% trailing stop system with the 1% total risk system. Now our next system, completely different system, is our 20-month simple moving average system. Now, the action item. Right now, the index went above the 20-month moving average, so it's time to buy the S&P 500 index fund again. So last month, if you were in cash or if you were in a bond fund, now is the time to sell the bond fund or take the cash and buy the S&P 500 index fund and get back in. And here's the data that supports what we're doing right now. So if you take a look at this up-to-date graph, the current price of the fund is 192.06 per share. That's the VFI index I use as a proxy to calculate out the 20-month moving average. And the moving average is at 184.30. So the fund price is larger than the moving average price. This is this model's get-in signal. So next system, completely different system now. We've already talked about the trailing stop loss system. We've already talked about the 20-month moving average system. Now this completely new system or next system is the MRI or the monthly rotation investment system. This one, current action is sell 25% of your portfolio's worth of the inverse fund and buy the index fund for this month. Or the variant of the model, last time we were 50% cash and 50% inverse fund. Now sell your inverse fund and be 100% cash. So here's your action items. For those of you who this is enough, this is enough. Meanwhile, let me talk about how we got this. So here's last month's prices, this month's prices. The S&P 500 index went from 177 to 192. That's up 8.4%. The emerging markets went from 2099 to 2216. That's 5.6%. The inverse fund went from 1529 to 1407. That's minus 8%. So here we have again a clear winner, the S&P 500 index fund. So last time we bought more inverse fund. Now we're going to buy more index fund. So if you think about this 25%, 25%, 25%, 25% pie chart, last time we were roughly 75% inverse fund, 25% index fund. Now we're supposed to sell 25% of our portfolio's worth of the inverse fund, buy the index fund. So now we're roughly 50-50. And for those of you who understand that one inverse fund roughly cancels out one index fund, this one cancels with this one cancels with this one, we can effectively be all cash for this month and save ourselves a commission. So summary, we went over the 25% trailing loss system and answered the question, I got stopped out, now what? Then we reviewed the 20-month simple moving average system, and then we review the MRI system and our current action plans for these systems. Keep those questions coming. I know I talk to several of you personally each month, but for those of you who only hear about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. And until next month, invest safely.